Are you tired of not knowing how to make your money work for you? Are you worried about not having enough money? In this video, I'm going to give you a guide to investing. Stay with me, and let's get you in the game. Before you even think about putting your hard-earned money on the line, you gotta ask yourself, what am I saving for? Is it a comfortable retirement, leaving a legacy, or buying your dream house? Write these dreams down. Make them vivid. Because these dreams, my friend, they're the fuel that's going to keep you going when the markets get rough. Now let's break those dreams down into bite-sized pieces. What do you need to achieve in the long term to make that dream a reality? Maybe it's building a retirement nest egg, or creating a trust fund for your family. Having these goals clearly defined is like having a roadmap to financial success. It gives you direction and helps you stay focused on what's important. Write it down, make a plan, and let's start building that dream together. Alright folks, let's talk risk. Now, I'm not talking about jumping out of airplanes or swimming with sharks. I'm talking about how much of your hard-earned money you're willing to put on the line to achieve those financial dreams we talked about. It's about understanding your comfort zone when it comes to investing. Now, there are generally three types of investors: conservative, moderately conservative, and aggressive. Let's break it down. Conservative investors, you're the folks who like to sleep well at night. You prefer stability and predictability over high returns. You're okay with slow and steady growth, and you don't want to see your investments take a nosedive. The idea of losing money keeps you up at night. You'd rather invest in safe havens like bonds and GICs, even if it means lower returns. Safety and security are your top priorities. Moderately conservative investors, you're a bit more adventurous. You're willing to take on a bit more risk for the chance of higher returns. You understand that with greater risk comes the potential for greater rewards. You're willing to ride out some market fluctuations. You're comfortable with some fluctuations in your portfolio as long as you're on track to meet your long-term goals. You balance risk and reward carefully. Blue chip stocks and index funds are your bread and butter. You like a mix of stability and growth. Now for you aggressive investors, you're the daredevils of the investing world. You thrive on high risk and high reward. You're not afraid to embrace volatility, and you're in it for the long haul. You understand that big gains often come with big risks. Remember, there's no right or wrong answer here. Each type of investor has their own unique approach and comfort level. The important thing is to be honest with yourself about how much risk you can stomach. Knowing your risk appetite helps you make informed decisions that align with your financial goals and personal comfort. So, take the time to assess your risk tolerance. It's a crucial step in your investment journey, ensuring you stay on the path that's right for you. Alright folks, now that you've got your goals set and you know your risk tolerance, it's time to figure out how you want to invest your money. This is a crucial step in your financial journey, and understanding the different approaches can make a significant difference in your investment outcomes. Do you want to be the captain of your own ship, steering your investments towards your goals? Or do you prefer to sit back, relax, and let someone else handle the navigation? That's the difference between active investing and passive investing. Each approach has its own set of advantages and challenges, and the right choice depends on your personal preferences and financial situation. Active investing is like being your own financial manager. You're in the driver's seat, making all the critical decisions. You're calling the shots, researching individual stocks, analyzing market trends, and buying and selling investments based on your own judgment. This approach requires a deep understanding of the market and a keen eye for detail. It's a hands-on approach that requires time, knowledge, and a healthy dose of confidence. You need to stay updated with market news, economic indicators, and company performance reports to make informed decisions. Passive investing, on the other hand, is like putting your money on autopilot. It's a more relaxed approach where you don't have to worry about the day-to-day fluctuations of the market. You're essentially investing in diversified funds that track a particular market index, like the S&P 500. These funds are designed to mirror the performance of the market, providing broad exposure to a variety of assets. These funds are managed by professionals who do all the research and rebalancing for you, making it a much more hands-off approach. This can be particularly beneficial for those who lack the time or expertise to manage their investments actively. Now, which one is right for you? Well, like most things in life, it depends. Your choice should align with your financial goals, risk tolerance, and the amount of time you can dedicate to managing your investments. Active investing offers the potential for higher returns, but it also comes with higher risks. You need to be prepared for the possibility of significant losses, especially if the market doesn't move in your favor. Passive investing, on the other hand, is all about slow and steady growth. It's a long-term strategy that aims to build wealth gradually over time, minimizing the impact of market volatility. It's a great option for folks who are just starting out, don't have a lot of time to dedicate to managing their investments, or simply prefer a more hands-off approach. It allows you to benefit from the overall growth of the market without the stress of constant monitoring. Now, there's also the option of hiring a financial advisor. A professional can help you navigate the complexities of investing, tailor a strategy to your specific needs, and provide ongoing support and advice. Ultimately, the best way to invest is the way that you're most comfortable with. Whether you choose to be an active investor, a passive investor, or a combination of both, the key is to stay informed, be patient, and remain committed to your financial goals. Thank you for staying with me thus far. Please go ahead and like this video as you discover more. Let's talk about the different accounts you can use to invest your money. One popular option is a tax-free savings account, or TFSA. This is like a magical piggy bank where your money grows tax-free. Then there's the Roth IRA, a retirement account that lets your money grow tax-free in retirement. Now, if you're not ready to commit to a retirement account just yet, you can always open a brokerage account. This is like your all-access pass to the world of investing. You can buy and sell stocks, bonds, mutual funds, and a whole lot more. There are also robo-advisors, which are like the cruise control of investing. You simply answer a few questions about your financial goals and risk tolerance, and they create and manage a portfolio for you. No matter which account you choose, make sure you understand the fees involved. Just like those pesky tolls on the highway, fees can eat into your returns if you're not careful. So, read the fine print, compare your options, and choose an account that fits your needs and your budget. Alright folks, let's talk about how much money you should invest. Now I know what you're thinking, Leroy, I don't have a lot of money to invest. And you know what? That's okay. You don't need a fortune to get started. The most important thing is to just start, even if it's just a small amount each month. Remember, it's not about timing the market, it's about time in the market. The sooner you start investing, the sooner your money can start working for you. Now here's a golden rule of investing. Never invest more than you can afford to lose. That's right, I said lose. Investing always comes with some level of risk, and there's always a chance that you could lose money. Once you've determined how much you can afford to invest, it's time to set up a system for investing consistently. The best way to do this is to automate your investments. Set up automatic transfers from your checking account to your investment account each month, just like paying a bill. Remember, investing is a marathon, not a sprint. Alright folks, let's dive into the exciting world of investment options. This is where things get interesting. There are so many different ways to invest your money, from stocks and bonds to real estate and gold. Let's start with the basics. Stocks. Stocks represent ownership in a company. When you buy a stock, you're essentially buying a tiny piece of that company. If the company does well, its stock price goes up, and you make money. If the company does poorly, its stock price goes down, and you lose money. Bonds are like loans that you make to a government or a corporation. When you buy a bond, you're lending money to the issuer for a fixed period of time, and in return, they pay you a fixed interest rate. Bonds are generally considered less risky than stocks, but they also offer lower potential returns. Real estate is another popular investment option. It can provide you with rental income and potential appreciation in value over time. However, real estate can also be illiquid, meaning it can be difficult to sell quickly if you need to access your money. Gold is often seen as a safe haven asset, meaning that its value tends to increase during times of economic uncertainty. Now, before you go investing in any of these asset classes, it's important to do your research and understand the risks involved. Each asset class has its own unique characteristics, benefits, and drawbacks. For instance, stocks can offer high returns but come with higher volatility. Bonds, on the other hand, provide more stability but usually yield lower returns. Real estate can be a great way to diversify your portfolio, offering both income and growth potential. And gold, while not generating income, can act as a hedge against inflation and economic downturns. Consulting with a financial advisor can help you determine which asset classes align best with your financial goals and risk tolerance. Diversification is key to managing risk and achieving a balanced investment strategy. By spreading your investments across different asset classes, you can better protect yourself against market fluctuations. Remember, the goal is to build a portfolio that can weather various economic conditions and help you achieve your long-term financial objectives. So, take your time, do your homework, and make informed decisions. Happy investing! Well, folks, we've covered a lot of ground today. We've talked about setting financial goals, understanding risk tolerance, choosing investment strategies, and exploring different investment options. But our journey to financial freedom doesn't end there. Once you've made your investments, it's important to review them regularly to make sure they're still on track to meet your goals. How often you review your investments depends on your investment strategy and your risk tolerance. When reviewing your investments, ask yourself these questions. Are my investments still aligned with my financial goals? Has my risk tolerance changed? Are there any new investment opportunities I should consider? Is my portfolio properly diversified? Rebalancing involves selling some of your winners and buying more of your losers to bring your portfolio back to its original asset allocation. By regularly reviewing and rebalancing your portfolio, you can help ensure that your investments stay on track to meet your financial goals. Well, folks, I hope you found this beginner's guide to investing helpful. Remember, investing is a journey, not a destination. It's about making smart choices today to secure your financial future tomorrow. If you found this video helpful, please give it a thumbs up, leave a comment down below, and subscribe to this channel and share it with your friends and family. You may visit me at leroybrown.ca. Let's build a brighter financial future together.